Let me destroy one of the most dangerous assumptions investors still hold, that the US stock market is the center of the world. Look at this chart, and you will realize that at the end of the day, South Korea plus 82%, Peru plus 78%, Greece 76%, Poland 71%, Colombia 70%. Meanwhile, the US just 17%. Join this channel. Give me some thumbs up in order for you to understand what is happening in the stock market and how to make money in the quote-unquote stock market. In this particular video, we're going to look at global equity. Can you make money, right? Can you make money out of the world? Forget the US for a while, because the US up just 17%. This is not a rounding error. This is a global regime shift. So we're going to break down exactly what this is telling you and why ignoring this, it is one of the biggest portfolio mistakes of this cycle. So let's take a look at this in greater detail so we better understand what's going on. Look at the top performers, right? Look at the top performers. We are talking South Korea. We are talking Peru. We are talking Greece. We are talking Latin America, Poland, Eastern Europe. These are not meme markets. They share three critical traits. One, deep undervaluation. Most of these markets entered 2025 at single-digit PE ratios. Remember, that is how you make money in the stock market, by investing in low PE stocks. I'm not saying low growth. I'm saying low PE, meaning you pick a stock that no one notices and has growth potential, and then you actually invest, and then the PE ratio goes up. How do you think NVIDIA or Tesla got there? 2, commodity leverage. Energy, metals, food, industrial inputs. These countries benefit from inflation instead of being crushed by it. Three, weak starting currency. As the dollar stabilizes and weakens, US-based investors receive a currency tailwind on top of equity gains. This is a classic late cycle behavior. So Europe's quiet comeback. Take a look at the Eurozone, plus 38%. For years, Europe was dismissed as too regulated, too slow, too old. That narrative ignored one thing. Europe was cheap. You need to buy when everybody else is selling and sell when everybody else is buying. And when inflation reprices a real economy, industrials, defense, energy, infrastructure, Europe wins. This is not a growth story. This is not. This is a repricing story, right? Because the U.S. is no longer diversified. A handful of mega stocks dominate returns, valuation, and narrative. You need to realize where the opportunity is, and this is why this channel is about. When capital stops growing or crowding into the same names, returns flatten. This is not a bear market signal. This is a rotation signal. It's a rotation warning. Look at these numbers, right? What are we looking at? Well, we're looking at some interesting numbers, quite frankly. Okay. World ex-USA is up 30%. EAFE up 30%. Emerging markets 29%. This is not stock picking. This is allocation. Passive U.S. investors are unknowingly making a macro bet that U.S. assets will always outperform. You know, this is showing you that the bet is no longer free. What do you mean by free? Meaning that doing nothing is not an option. If you're looking at the action over there and the real action is over there, you're missing out on that action. Even though you think you're doing well, they're doing a lot better. So you lost that opportunity. That is why it's called the opportunity cost. What are the countries that have failed? Well, look at the laggards. Look at Saudi Arabia, right? Saudi Arabia is minus 7%. Turkey, right? Minus 1%. India, flat. Thailand, flat. Why? Well, overcrowded trades, political risk, valuation bubbles, high growth does not equal high return. It does not. And that's what you're seeing. Markets punish expectations, not fundamentals. Meaning that if you expect too much and there's no fundamentals, you're going to get hurt. So what does this mean for your portfolio? Well, this chart is not telling you to sell America. It is telling you this: diversification is back. And if you join my Patreon channel, I will show you how to take advantage of these things. Valuations matters again. Global cycles are real. The biggest risk right now is not volatility. The biggest risk is home country bias. I don't know anything else about. The world is outperforming the US, and capital is already moving. The question is, are you moving? Best formula is to take the return on equity and divide that by the price of book, and you get the annual return if they all stay the same. That's a good point. I like that point. All right, let's talk about something else. For the first time ever, professional fund managers are no longer worried about inflation. They are no longer worried about geopolitics. They are no longer worried most about bond yields blowing out. They are worried about one thing: an AI equity bubble. This is not a Twitter speculation. This is not retail fear. This is not doom spotting. This comes directly from Bank of America Global Fund Manager Survey, the most widely followed institutional positioning survey in the world. And according to this survey, 33% of global fund managers now see AI equities as the single biggest tail risk in markets. Now, what do we mean by a tail risk? Well, basically, what we mean by a tail risk is the idea that we kind of know what's happening. And basically, a tail risk is essentially a black swan. And this is what this channel is about. It's about where are the black swans? Where are the tail risk, right? They're saying, you know what? We should have a normal distribution and things should be like that. But maybe there's a risk that is small, right? And that nobody is looking out for. And if it hits, it could hit everyone. According to this data, 33% of global fund managers see AI equities as the single biggest tail risk in the markets. Now, I will tell you, this is a problem. It's also an opportunity because as long as they keep saying that there's a risk with AI, I don't think there's a risk with AI, quite frankly. But you should be aware of it. So this is unprecedented, right? Today, we're going to break down why AI has officially become the market's largest systemic risk, why this is not about whether AI is real, why bubbles from precisely when the derivatives is strongest, and what happens next when positioning, valuation, and expectation collide. Stay with me because this is how bubbles actually end. Let's look at this very carefully, right? What are you seeing? Well, at the very top, you see the equity bubble minus 33%. Right? You see the 33%? That's the first bubble. Take a look at it. So is because so get back to the information Fed and right?